Good morning, everyone. Alex Eicher, TCTITLEGUY Podcast. December 21st today, right before Christmas. I'll probably put this episode out this week.
Bro, it's December 22nd.
Is it really?
Yeah.
Shoot. 22nd. 22nd. We are 3 days away from Christmas. 23rd, 24th, 25th. Short week this week when it comes to work for me. Obviously, if something hits the fan, I'll be able to answer my phone. But we are not open on Christmas Day or Christmas Eve or Christmas Day. Closed next short week next week as well, with New Year's limited hours, and then closed New Year's Day. I've got an interesting interview today. We are here at OneTrust Home Loans with Ian Ashton, the owner. Part owner?
Nope, just an employee.
Just employee. Excuse me. The regular
So far.
The regular owners are out of.
So our company is, the majority owners they live in Puerto Rico, but our company's based out of San Diego.
So we are at their office location today, actually at Todd Gill's desk, and he's texting me just now, giving me some crap about, Michigan basketball. And I said, be careful, man. Be careful. Because I'm at your desk. You don't want to mess with me when I'm at your desk. Literally, it's funny that he messaged me that right when I'm in his office. This time of year, the weather's been getting kind of cold, snowing right now. We had a little bit of a warm up, then it gets cold again. Ice fishing. I went out last week, caught a few fish, if decently safe. I'm going out tomorrow with a bunch of people. Looking forward to that. But I want to talk about a hot topic. As we have seen in the last, a couple years ago, rates, really were at a great point. They were sitting right around, 2-3%. If you got very lucky, you had a nice interest rate. And people think that, that hopefully that we can get back to that point at some point. Well, the problem is, with that being said, lower rates, the prices will increase substantially. And obviously we can attribute that to COVID, and maybe Ian can highlight that a little bit, because I wasn't in the industry at that point. I was actually looking to buy at that point. But fast forward, now we saw rates get hiked up. So I guess, Ian, what I want you to talk about is how they got hiked up by the Fed. I'm assuming that it was by the Fed, but now the rates are getting decreased by the Fed, but that's not exactly, if we see, they're going to cut it a 0.25%, 0.5%, you see that across the media, that doesn't dictate the mortgage rates.
That's right.
So they decrease the rates, but it doesn't dictate the mortgage rates. It has to do with the bond market and buying. It's a bought and sold kind of thing. Ian's going to highlight that today. Ian's been in the industry for how long?
I started in 2001.
2001, okay. Don't be afraid to get that mic right by your face there. Ian's very well versed in the industry. He's always talking about, how rates are depicted on, the bond market. I don't want to talk about that too much. That's his job. But what I'm trying to say is that's why I'm doing this interview today, because I want to talk about with somebody that really knows about this stuff. Because I'm actually going to learn today. This is a true, authentic thing. It's not like I know too much about it. Ian's going to dive into that. Take it away, my brother.
Yeah. So the Fed does not set mortgage rates, right? The Fed sets short-term interest rates, so like your credit cards, your auto loans, that kind of stuff, home equity lines of credit. But the Fed does not set mortgage rates. What the Fed does is we say they set the tone for the market. So interest rates were really low during COVID because the Fed started printing money, right? And there was all sorts of stimulus, and the Fed was buying mortgage-backed securities. I guess taking a step back, mortgage interest rates are determined by pricing of mortgage-backed securities, which trade just like stocks. So every single day when the stock market's open, the bond market, there's a similar market called the bond market. And essentially what happens is traders will sort of see what the Federal Reserve is saying or doing, and they'll say, all right, we think the Fed is gonna hold their policy rate a little bit higher. So maybe that will have an impact on mortgage rates or on bond rates, but not directly, right? So essentially the market, just like how you see economic news for stocks, earnings were good for this company and their stock price gets better. For the bond market or for mortgage rates, what will happen is if we see something in the economy that's bad, like jobs are down, or inflation is up. Usually those kind of things are what will impact the bond market. So generally speaking, what's bad for the economy is good for the bond market. And the reason for that is that the government or traders expect that the government will kind of come in and rescue it and inject cash. So like during the pandemic, mortgage rates weren't low because people were nice and were like, it'll make life easier if everything costs less. Mortgage rates were low because the government injected a massive amount of money to essentially to subsidize and to bring those rates down. And arguably they did too much, right? So that kind of led to the inflation and the home price appreciation that we saw. That's just off the chart. So it's an interesting balance that you see with the market. The Fed is always doing something, and hindsight's always 20/20. They have a lot of critics, right? People will be like, the Fed doesn't know what they're doing, or they're terrible. Well, it's really easy to look back and say, man, I would have done it differently, but nobody knows. We're kind of in uncharted territory with every sort of economic thing that comes up that the Fed has to navigate.
So if I'm a new home buyer, and I kind of understand what you're saying, but explain that to me in more of like a layman's terms, especially with what's going on right now. Like, Fed cut rates, massive headline across the U.S. Mortgage rates could go down because you've seen that too.
Oh, yeah.
Or they say they will go down. Well, yeah, that may be eventually, but dive into that a little bit.
When we talk to customers about rates or about payments and stuff like that, usually what I tell people is the market is what it is, right? It's going to go up, it's going to go down, and it's something my financial advisor tells me all the time is like, you're never going to time the market perfectly. So we build your budget, and if rates are 6%, great. If you can get the house that you want with the payment that you need based on where the market is, great. If not, then maybe it's not the right time to buy. But waiting for rates to get better or for prices to go down, it sounds like a great idea, but it's really very few people, I think, have been successful in that, right? So like if you were waiting since, keep it in this monitor, if you were waiting since 2024, 2023 for rates to come back down to where they were in 2021 or 2022, what happened is rates came down a little bit. They might have been 7%, now they're 6% or whatever, but prices also went up. So what happens is rates might come down a little bit, but prices go up. So any amount of money you would save yourself on lower interest rate, you lost on higher appreciation. So timing the market it's just not. I try to talk people out of it. In fact, like when we qualify people and do a pre-approval, especially for a first-time buyer, we'll say, if the market rate right now is 6%, when you find the right house and you're ready to make an offer, great. We're going to qualify you and give you the lowest rate we possibly can at that time. But when you're shopping, let's bake it up a little bit and say like, all right, well, if the market is 6%, let's base all of our assumptions and our estimates on 6.5%.
Yeah.
Not because that's a rate that you're going to get, but if you're budgeting for it to be a little bit more expensive, then when you start sharpening the pencil and find the right property, you won't be disappointed if it's a little lower of a payment when the rate's better versus if you're banking on that rate being 6%, right, and then when it comes time to lock it in at 6.25 or something, that's a bummer. So
let's talk about taxes.
Oh,
so
yeah.
that's a big subject too. So I can afford this, and this. Well, if you're working with a good keyword local loan officer, I think that any loan officer should be doing this. But I sell local. I love to pour into people in the industry that are local as well, that are in the real estate industry, not just the real estate industry. Actually, like for instance, we go to Potter's Bakery down the street. We buy local there for our Christmas gifts every year. You catch my drift. Talk about taxes. Talk about how they can get substantially.
Yeah.
You can afford this, but then all of a sudden you buy a waterfront property and you're like looking at thousands and thousands of dollars more.
Yeah. So what we see in Michigan is relatively unique compared to the rest of the country. And the reason why I highlight that is because we have so many people that move to northern Michigan from other parts of the country. So in Michigan, property taxes are based on, there's a couple of values assigned to a property, right? So you have your taxable value, and that's what you pay taxes on. And that amount can only increase a certain amount per year from when you buy the house, right? So like it's 5% per year or whatever the inflation rate is. So what will happen is if a seller has owned a house for a really long amount of time, the taxes get capped, is what we call it. So the taxes will not increase relative to what the actual value of the property is. It's only increasing at that capped amount. So when the seller sells that property, the cap comes off and the tax is reassessed. So what we've seen, especially in the last couple of years with the crazy house price appreciation, is that a house that might have been $200,000 5 years ago is $400,000 or $500,000 today. The taxes, when the seller sells that house, the taxes were originally based off of it being a $200,000 house, and the seller owned it for a really long time, so they go up just a little bit. Well, they sell that house, the cap comes off. Now the house is reassessed based on it being a $400,000 or $500,000 house, and the taxes might double. Right?
Give me a realistic kind of figure for our audience of what you're talking about. Like with the original before it was sold, 25-year person owning it to potentially a new home buyer.
So like one of my good friend's assistants bought a house, and the taxes when she bought it I think they were $2,100 a year.
Yep, and that's winter and summer taxes together, exactly. Combined.
Both tax bills, $2,100. Michigan pays taxes in arrears, so it takes a year for you to catch up to the assessed value, right? So her tax cap came off, and we knew that it was going to come off, so we collected a little bit extra in escrow. What happened for her is that the millage rate where she lived went up, the taxable value went up. So essentially, her taxes went from $2,100 to, I want to say it was like $5,800. It more than doubled. And we had accounted for it. Like we had said, like, all right, well, $2,100, and we calculated manually, they're probably going to be, about $4,000. And even with the set aside that we had to collect for more, we were still short because just the market in that specific town that she was in just kind of went crazy, and it was just like the perfect storm. But had we not budgeted for that straight away, like that would have been, it was a headache for the customer, right? Like nobody wants to pay more in property taxes, but in this instance, we were able to defray it a little bit, but that stinks. And a lot of times when you work with a lender that doesn't necessarily know how Michigan taxes work, they might look and say like, oh, yep, $2,100, that's what the taxes are. Your payment's based off of that. And then a year later.
Have you been seeing that with other non-local lenders? Let's just call them that.
Yeah, we see it quite a lot. Like,
what I mean by local, not just Grand Traverse County, but local to northern Michigan, I guess I should say Michigan in general. That's what I mean by that, that are not local. Big book financial institutions.
Yeah, so like call centers, we'll see people that will get a loan from a national advertising, non-bank mortgage lender that has really cool TV commercials or something. Or, we've got great technology.
And they're advertised by a celebrity.
Yeah, right. And every time. And what will happen is that person will call us and be like, yeah, our mortgage, we thought we got this great setup, but they just sent us a mortgage bill that's $500 more. And they're saying it's because of our taxes. Can you help us, understand this? Or I guess one of the things that my team does here is we'll say, like, we would love to help anybody with their mortgage, right? Like, obviously, we're a for-profit company, so we want to get as much business as we can. But whether we do the loan or not, we're still a resource. So, like, if you have a customer, if you have a friend or whatever that's struggling with figuring out how their escrow account's calculated, whether it's our loan or not, we can certainly look at the paperwork and tell you exactly what's going on and possible ways to fix it. So pretty often we'll have that call in, like, hey, can you help us figure out this? A realtor will call, my buyer's taxes went way up. Can you help him figure it out? And 9 times out of 10, it's just the lender didn't do a really great job explaining or setting it up in the beginning, and it definitely stinks for people that are in that situation.
They're looking at, the interest rate alone, not looking at the big picture.
Yeah, you got to look at everything, right? Because like owning a house, there's a lot of expenses, and one of the things we say to people too is like, there's a lot of numbers involved, a lot of ratios when we calculate what a person's qualified for. We'll say, like, one of the things I tell people is there's 2 numbers. There's what you could qualify for, and there's what you want to qualify for. And often there's a big difference, right? Some people will say, I want my payment to be $2,000 a month. Awesome. That yields this purchase price. You're eligible for a payment of $4,000 a month. Not necessarily you want to make that payment, but you certainly could. So having that discussion and kind of showing people, like, just because you can qualify for it doesn't necessarily mean you want to. I think is a pretty important part of our job, and really something that every lender should be having those types of discussions with people, because there's nothing worse than I've never done it, but we've had customers that'll buy a house, live in it for a year, and then sell it to downsize or to get rid of it because they don't want to have all of the expense associated with it, whether it's property taxes, or maybe they bought an older house that needs a lot of renovation or work or something. And it's like people get caught up in the excitement of like, this is the house, this is great, we're going to do this and we're going to do this. And they sort of lose track of the fact that it's like, there's a lot that goes into owning a house. Mm-hmm. So just finding the right one and working with somebody you trust on the real estate side and on the lending side, I think makes it a lot.
I think you make a good point just now, Ian. If you get a loan, a mortgage, a loan with OneTrust Home Loans with Ian, Todd Gerald, Adrian Maley, local here in Traverse City, and you have questions after the fact, a year later down the line, you're gonna call Ian or those two other individuals, and you're gonna get that individual.
Yeah, we always say like there are all the 800 numbers, but like save my cell and shoot me a call or a
231 number local. Even though
mine's actually 586 because I moved here, but you know,
same to me. Mine's 810. I was just about to say but you catch my drift. You're gonna get Ian. There was something else I wanted to talk about mortgages and It was actually really good. Oh yeah. So the next thing I want to talk about is that I see a lot on the title side is like, oh, the deal blew up over somebody buying a car.
Oh yeah.
Or they opened a credit card.
Undisclosed debt, we call that.
So Ian, if you want to talk about that, going through a process, I'm assuming you guys communicate that, but people just unfortunately just don't listen. Or I hate to be that blunt, but
yeah, so when we set up a loan, your qualification is based on a snapshot in time, right? So we'll do a pull of your credit, and we'll look at your pay stub. And that tells us
debt to income ratio,
and we'll look at your bank statements, see how much money you have in the bank, and that kind of thing. So we'll base all of your qualifications on the information that we have at that point. But as we work through the process, there's still other boxes we have to check and documents we have to get. So from a qualification standpoint, when we do a pre-approval, we'll say like, yep, you're pre-approved based on all of this information. But if you go and buy a new car that has a new payment, that changes all of your ratios. Or if you go to the casino and spend all of your money and gambling or whatever, and we've had it before where somebody will say like, oh yeah, I'm under contract on this house and I got in a car accident, so I had to buy a new car. Oh no, that's a bummer. Like obviously that's an unavoidable situation. What was your old payment? Well, my old car payment was $350 a month, but my new car payment's $900. That's a lot of extra debt that we have to factor in. So we've definitely had scenarios where people will make a large purchase, or
what it probably is I'm assuming they got a very good job and they're making way more money nowadays, and then they crash their old car, and they're like, I could afford a Mustang now. I'm just gonna go buy a Mustang.
And it's we try not to qualify people to the very edge. So most customers are going to have a little bit of wiggle room in there, but we've definitely had those scenarios where it's always an Escalade, right? Like that's the joke. Like, well, don't go buy an Escalade before closing because that will probably blow this thing up. But so we try to educate people and let them know, like, don't deposit a bunch of cash in your bank. Don't take a bunch of cash out. Don't buy something. Don't open new credit. Every little thing that might not seem like... In fact, just on Friday, I had a customer getting ready to close. He's closing, first-time home buyer, closing on the 30th, so right before the end of the year. And he texted, he's like, hey, Amazon has this deal where if I open a new credit card, they'll give me, $100 or something like that. He's like, should I do that? And I was like, bro, please don't. Like, not that it will impact your qualification, but so lenders have what's called undisclosed debt monitoring. So like during the entire loan process, a lender has to monitor your credit, because if you open new credit right before closing, that could impact your ability to repay the loan, and we don't want that, right? So like I was like, even though you're super well qualified and I'm sure the payment on this credit card won't disqualify you, it does create a bunch more paperwork that we have to, rustle through and get set before closing. So just wait, another week, and then you can get your Amazon $100 or whatever. But yeah, it's interesting, the unintended consequences that because like a mortgage is all encompassing, right? I joke around and tell people when we do a pre-approval, it's like a financial colonoscopy. Like we look at every possible metric, everything you've got. If there's a skeleton in the closet, we're going to find it. So it's best that we talk about all of them up front so we know and we can navigate around them.
Yeah. Ian, was there anything else you wanted to highlight on a loan-specific real estate industry?
No, you always see headlines and it'll be like the market's great or the market's bad or it's a buyer's market or it's a seller's market, and I think all that's crap, right? Like I think it's we are in a needs-based industry, so some people need
Better than paying 100% interest rate,
right,
renting or leasing.
to your landlord. But it's like if you need a place to live, then you work with the right people and you find the place that's appropriate for your
budget. What's the term?
And
you can always refinance later.
You can always refinance later. And like I'm not a big fan of like I hated the marry the house and date the rate or whatever. Like that's terrible advice too. Get in the financial situation that you can afford now, and if it gets better down the road, great. But at least if it doesn't, you're not no worse off.
And then when you're making payments without the 100% interest rate, when you're making payments on something that you own. Granted, a lot of it goes to taxes and other things, but still, you're creating equity.
Yeah.
And then even if you make, this is a good touch point, Ian. If you make just subtle, more little incremental payments each month on your mortgage, that makes a substantial impact on the long term. Let's say you have a 30-year fixed. Talk about that.
Yeah. So mortgages amortize. So what that means is you pay interest based on the amount that you owe. So like an auto loan or a student loan is called simple interest, where I don't know, it's a way more in-depth topic. But essentially with a mortgage, every little bit extra you pay puts you further ahead in the payment schedule. So because the interest that you pay is calculated based on the balance owed in that payment period, if you send in, whatever, a common one is make one extra payment every year. So essentially, if you pay 1/12 of your mortgage payment extra every month, your payment's $1,200 a month, and you pay an extra $100 a month, you'll probably end up cutting about 9 or 10 years off the end term of the loan. So when you look at that, if you cut 10 years off of a 30-year mortgage, I'm going to chop a third of it off, it's 120 payments. So if you have 120 payments you're not making because you sent in an extra 100 or whatever.
I don't have my calculator because my phone is.
It's a lot,
over there,
right?
and I got to actually get a call from an agent.
That's what I thought you were.
No. So if you got a 2,000, yeah, right. What's up, Doug? Shout out to you. $2,000 payment a month times 100. I'm terrible at math, but
yeah, you're gonna save a couple $100,000 in interest.
$200,000,
or whatever it is, because you're cutting that many payments off the end. So, the key there is. We have a lot of customers that locked in a low interest rate in 2021, 2022, whatever. And they're like, oh, I've got this 3% mortgage and I can't wait till I have no mortgage. Bro, if you're paying 3% on your mortgage, ride that thing out to the bitter end, because you're never going to get money that cheap, right? If you have $100,000 in the bank or $100,000 in the stock market or whatever, you should be able to earn way more interest on that cash than you would be saving on the interest you're paying.
And that brings up a good point. 1, baby boomers, and 2, people with low interest rates. It's hard to get somebody to say, hey, look, you should downsize or whatever, and go to an 8% interest rate and move away and then get rid of your 3% interest rate.
Yeah,
or
that's called a lock-in effect, right?
Or you've got people that, baby boomers that are, in their 60s that made a lot of money because of the rule of 72, right? Where they're putting a lot of money away in their retirement, and it's increasing over time. Anyways, I don't want to get into all that, but you got 2 factors right now that's affecting the market. What is affecting inventory? But anyways, you want to dive into that, Ian?
Yeah, that's exactly. So I was saying it's the lock-in effect, right? So you've got taxes, like we talked about. So if I sell in fact, my wife and I looked at this. We were considering building a new house, and we bought the land and everything, and we're like, wait a minute. When we move out of the house that we live in now and move into what will be this new house we're building, our taxes go from very low to insane. Like, what are we doing? So, for us, we just were like, wait, we don't actually want to move. We like where we're at and whatever. And I think a lot of people have had to make that same, or had to come to that same realization, which is like the cost of moving into a new house is so much higher than what you're locked into right now that a lot of people aren't wanting to let go of that low rate or that low tax rate or whatever it is. We're starting to see a lot of that ease up, and part of that is just as interest rates come down, right? Like when rates were 7.5% or 8%, to go from 4 to 8 is a huge jump.
Yeah.
To go from 4 to 6 is, it's still a big jump, but it's not nearly as bad. Go from 4 to 5 is a lot closer. So I think as we see interest rates come down slowly, and they have been, like, I don't have the chart in front of me, but roughly since August or something of 2023, rates have been very slowly trending down, and you'll have the ups and whatever in the middle. But
I bought in October.
There you go.
2 months after that, so it was like almost 8%.
Yeah, and it's like
and a good. We both, my wife and I, have good credit. So
it's crazy too. Like we saw nobody. Hindsight's 2020. I think I said that earlier, but nobody would have ever in a million years guessed that rates were going to go from where they were to where they went. Right? Like we saw rates jump so fast, so high. It blindsided a lot of us, and everybody thought, "Oh man, rates are going to come back down." Right? So for like 2 or 3 years, that was sort of the thing that buyers would say, like, "Oh, I'm going to wait until rates come back down." And you might be waiting a really long time, and like I said, when we started,
but even to a 2-3%.
Yeah, I don't think we're ever going to see,
right.
absent some catastrophe where the government has to come in and drop a bunch of money back into the system. Like the rates weren't that low because of anything other than government intervention.
And I want to interrupt a little bit. And you don't want to see a 2-3% interest rate again because you're going to get a ton of influx. It's up.
Yeah, I mean, it's supply and demand, right?
Supply and demand. Thank you.
So
Cheese o' Pete's.
There you go. So and that's an interesting thing, right? So like right now, I think we're in a scenario where supply is definitely pretty tight still, right? Because there's not as many people rushing into the market because interest rates aren't so low, and prices aren't low, right? That said, over the last year or so, we've seen housing prices start to settle down, and in some markets even decline a little bit from where they were. So, like I said in the very beginning, you're never going to time the market right where you've got falling home prices and falling interest rates, and you catch that falling knife perfectly. Like it just doesn't happen. So you got to just focus on finding the house that fits your needs and fits your budget at the time. And I think that for first time buyers especially, what we see is if you're moving out of your parents' house, your parents have worked their whole lives to build and buy and grow this wealth that is the home that you live in. So when you move out, you're like, oh, I want this feature and I want this location and whatever. Very likely your parents' first house was nothing like the house that they live in now, right? Like there's the move up effect. And my first house was 1,000 square feet, right? And we sold that one and made a little bit of money. And our next house was 1,700 square feet. We sold that one and made a little bit of money. And each time we did it, we moved up a little bit and reinvested that money and put a little bit more in. And now we've gotten to the point where we have, what I think is a wonderful house and we love it. But if it was my first house and we were going out to buy right now, no chance we could buy the house that we live in. It's like you really have to do that step up kind of a thing, I think. Yeah. And I think a lot of the first time home buyers get discouraged because they're like, oh my gosh, what I can afford versus what I want. There's such a wide gap in those two things, but really it's just part of it.
I gotcha. No, and then the last thing I want to talk about here, Ian, is this guy over here has I got a YouTube channel, but not even near on the level of amount of followers and subscribers, or that. So those are one and the same, but playing hours and stuff like that. I feel like I'm pretty well versed in YouTube, but this guy's got a heck of a YouTube channel. And I don't think it's necessarily all related to mortgage rates at all, or industry or anything like that. It has to do with muscle cars and drag racing. Yeah. And if you want to talk about that, what your YouTube channel's called?
Yeah. So on YouTube, my name is Dr. Ian Ashton. It's a joke. I'm not actually a doctor.
And that's one word, right?
Yes, sir.
Yep.
So I think I have about 6,000 or so subscribers on YouTube.
Yeah, I think I checked last time. It was like 6,500.
Yeah, and I go in spurts. So like right now I'm uploading a lot more to Facebook. So like I think I'm averaging 7 or 8 million views a month on Facebook. Wow. and close to 1 million or 500,000 or something like that on YouTube. But it's fun. Yeah, it's almost all car content.
I get happy. I make a 12-second short video and I got 9,500 plays. That's good for me.
That's great though, right? Like it's interesting. Like I used to only do long form content, like 20, 30 minute videos.
Yeah. Me too.
And just recently, starting in in September or so, I was like, a friend of mine does a lot, and he's like, you got to do more reels. I'm like, yeah, I don't really watch reels, so I don't really do them.
Yeah.
And I started doing it, and it's just like it absolutely exploded. So like,
me
follower
too.
count,
Me
view
too.
count,
Yep.
It's fun. I have fun with it.
But then it's like YouTube. I don't understand it sometimes. Like, yeah, it's frustrating to me because like I could talk about this a billion times over, but like short form content, like under 15 seconds, you have a highly likelihood of getting a decent amount of plays. I don't know.
You know what's interesting?
But short attention spans are getting.
Yeah. You know what's interesting to me is like I could upload 2 videos. Like I do a lot of car racing stuff, so I could have 2 cars, or I guess it'd be 4 cars, 2 races that are similar cars. Like I recorded them on the same day using the same gear. Like the videos are basically identical. It's just a couple of different cars, and even the cars in the video are similar. So like you would think that those 2 videos should get similar engagement and similar views, and one will get 100,000 views and one will get 2,000 or something. There's like the way the algorithm works is very interesting, and I
feel like YouTube bogs it down. And if there's not like people like watching your content when you post it, it's probably an AI generated thing. That's the way I feel. Like I'm gonna get a ton of plays on this video, and then I get like 200.
It's
right?
So weird.
I don't know. I can't explain. I don't know how to explain it.
It really, in what I've noticed, especially like since I started focusing on reels and on shorts and stuff lately, is like I said, there's no rhyme or reason to it outside of posting times. So like I post content at the exact same time every day. Like I upload 2 videos, and if I do it on Facebook, it's like I do an 8 a.m. release and like a 1 a.m. or a 1 p.m. or something like that.
So consistency.
Consistency. If I do it on YouTube, I got to do it a little bit later. Like if I upload those times on YouTube, I don't get nearly the views. But if I push it back a few hours on both uploads.
So how do you get your watch hours? It's a lesson, like because it's all about monetize. Because I'm assuming you're monetized.
Yeah.
So how do you get your watch hours with a short format content video? I don't get it.
Yeah, and for me, like I monetize because it helps the algorithm deliver. Like the YouTube or Facebook want to be able to sell ads on your content. So if you monetize, they're going to push your content more. So that's the reason why I do it. It's nice making money, but if I put the same amount of effort into my real job, I would make infinitely more money, right? Like I'm not getting rich on content, right? But it's like a byproduct of it is the money you make. So, for me, I never focus on the metrics, on the cash side metrics. I really look more on the initial engagement and what happens.
Do you edit your own videos?
Mm-hmm. I do.
You really?
Yeah. And I don't use AI for anything. Like it's all. That's why I'm so.
What is your editing program?
I edit everything. Nobody believes this. I do everything on an iPad, and I use a program called LumaFusion.
Okay.
And the reason for that is it's just the iPad like render speeds are way faster. I used to use Premiere Pro on Windows, and it's a great program. It's very powerful, but it's just slow. And for content, whether it's mortgage or real estate content or car content or whatever, the more you can churn out, the better off you're going to be. So it's every sales coach in the universe says quantity over quality for content, and it's true. Like you could put out garbage, but as long as you keep putting it out.
Yeah.
And not to say that you should.
Any content is good content, and I say that same turn to my clients. You got to start somewhere, and then over time, you could spruce it up a little bit. Like a client of mine posted a short reel the other day, and there's no underlaid music or anything like that, no brokerage logo. You could have gotten rid of a couple of filler words or whatever, spice it up a little bit.
They always say like your worst video is the last one you did, because every video gets a little bit better.
You could go back and look at my stuff from a long time, couple years ago. It's terrible, but you just get better as you go along. Like riding a bike.
You know what's fun too with content?
You gotta start somewhere.
Yeah, 100%. Like what I find is when I'm filming, if I'm like I do a lot of event stuff. So if I'm at an event, if I'm filming for YouTube or whatever, I'm so much more conscious of what I'm filming, because editing it down the road is so much more of a hassle if I've got a bunch of junk that I don't necessarily want, or duplicate clips, or poor camera work or whatever. So now it's like if I'm doing something just with my family or with the kids, I'll grab my camera, take a video, and who cares? But if it's like I'm at an event and I'm doing it for content, I'm so much more in the moment of filming than if I'm just taking a normal video, because ultimately the faster I can get the videos into the editing software, chop it up a little bit and get it out, the better off it's going to be, because just like in mortgage, we say speed to lead, right? Customer calls me. If I take 3 hours to call them back, they've already talked to somebody else.
Yeah.
Same with content. If I went to an event and I put out a video,
Yep.
if there's already 50 videos of that same event out and I'm the 51st one, nobody's going to watch it. You got to get out there quick.
Yeah, and that's a big. I would almost attribute to this too, and then I fall into this bucket. Patience nowadays is really short as well.
Yeah.
If you're not gonna pick up the phone, I mean, I'm gonna be off here, Wednesday, Thursday, Friday till next Monday. But my point is I'm gonna pick up the phone if somebody calls me, or I'm gonna call them back in a timely manner. I've lost deals, and I'm assuming Ian has too, because not a lot, but I've lost deals because I didn't call the person back within a timely fashion. I think a day is within a timely fashion, but that's even too long. A couple hours is too long sometimes.
And I always so I don't work with a lot of customers directly. I have a few realtors that I partner with, but everything else goes through our team here. And when I'm talking to a customer or I'm talking to a realtor, I'll say, like, how do you like to communicate? Do you want me to call you? Do you want me to text you? Do you want me to email you? If I, like, my personal preference, if I'm the customer in any situation, I prefer text. I hate talking on the phone because I spend my entire life talking on the phone. So if I'm putting myself in the customer's shoes, if I'm talking to a salesman, I say, just shoot me a text, and that's a way better way, to work with me, because I don't want to talk to you on the phone. No offense, it's just not what I want to do. Okay, cool. I ask customers that too. Hey, what's the best way for me to get information to you? You don't want a phone call? Then I'm going to text you, or whatever it is. And I think everybody gets so in their own head about that, like, oh, I better call this person. Well, if the person doesn't want to talk on the phone, don't call them. Shoot them a text or an email or whatever. And I don't know. We've kind of really gone off topic on this, but I like it.
No. This was where conversations lead.
Yeah.
And unless there's anything else you wanted to talk about, I do want to make sure I implement to make sure that people know how to get in touch with you on your YouTube channel, and then also your personal information here at OneTrust Home Loans.
Yeah. So on YouTube, like I said, I'm just YouTube Dr. Ian Ashton. It's all car content, so if you're not into that, don't go look for me. On Facebook, we're called OneTrust NMI. So Facebook.com/OneTrust. There's Adrian coming in right now.
What's up, buddy?
And OneTrustHomeLoans.com is our website, and you can find all of us on there.
Fantastic. Was there anything else you wanted to highlight?
I just want to say thank you for the opportunity.
Absolutely, man. Absolutely. And, here's the thing. If there's other loan officers, agents, whoever in the industry, we would love to get on the show and talk about real estate-related stuff to this, highlight, other touch points about how rates are depicted, and then with the feds and all that kind of stuff, you're more than welcome to come on the show and talk about it. I just met with Ian because he's always at the Women's Council meeting, really, really touching and highlighting on the touch points about how, like, yeah, the headlines say this, but guess what? This is really how it is. And that's why I reached out to Ian. I said, man, I got to interview you. So I would love to have anybody else on the show and talk about this subject as well. Alex Eicher, TC Title Guy Podcast. Please be sure to look out for other content upcoming in the future. I'm actually interviewing my title sales coach in the new year. We're going to talk about how we connected on YouTube. Of all places. We've actually never met each other. He is actually one of the biggest title sales reps in the nation. His name is Wade Vandermolen, DC Title Guy. We're going to talk about how we met, what we do differently in the industry on behalf of a title company, and then also other content in the future. This is episode number 9, believe it or not, for the TC Title Guy Podcast. Yeah, 9, I think. At least 8.
You just started a couple weeks ago.
Yeah, about a month or 2 ago. Yeah. Like I think this is 8, or it could be 9. I can't remember. I think it's 9. It doesn't matter. TC Title Guy Podcast. Please be sure to like, subscribe to below. Everybody have a great day. Thank you very much for being on the show, Ian.
Thank you.